Good afternoon and welcome. This is really our first live podcast today. Uh, it's always been our endeavor to spread education and awareness about personal finance and bonds, and who better to talk to on this subject than Neil Borate. Neil, welcome. Just a brief about Neil. He's a graduate in economics and law. He did his master's postgraduate in investment from University of Birmingham in the UK. He started his career as a mutual fund researcher at Value Research. And after a short stint in fintech, I wonder why short, I will ask you. In 2019, he was a mutual fund reporter at the Mint. In 2022, he became deputy editor. And congrats, 2024 editor for personal finance. Obviously, you've written co-authored a book on Rakesh Jhunjhunwala, The Raging Bull. Would love to hear your views on personal finance today. Welcome once again to India Bonds.
Thank you so much, Vishal. That was very kind. So, for those of you who don't know Vishal, he's had the dream career for every Indian student, I think. MBA from London Business School, worked in senior roles in Singapore and London, in all the big name banks you can think of. So, Morgan Stanley, Merrill Lynch, Deutsche Bank,
Deutsche Bank, yes, thank you.
and RBS as well.
For a stint.
So, all that you want to know about high finance, I think Vishal is the guy to go to.
Very, very kind of you. And obviously, I didn't like any of those jobs, and I'm a fintech co founder now, which has different challenges. But today, for the audience, what we are going to try and cover some aspects of personal finance and obviously on portfolio diversification and bonds. And we have a lot of questions from the registered participants already, our viewers. So we're going to address some of those questions and Neil, get the gems out of you. We have a surprise rapid fire section. We haven't exchanged what we're going to ask each other, and that should be very interesting. So let's jump simply straight into this. The first basic question: why is investing important, and what is the golden rule of personal finance?
So I think for most people who've seen this crazy market in the past few years, we don't even need to tell them. Like, it's apparent when they see their neighbors making a ton of money. I think that whole lesson is
Neighbors driving the BMW when they're in the Honda. Okay.
that lesson is driven home. But that said, I think starting early is really important. I think I would say that's the first rule of personal finance, because you give more time for your investments to compound, and that applies to both equities and bonds. Um, the second thing is to diversify. A lot of people put their eggs in one basket, and again, a market like this will make a lot of portfolios skewed heavily towards equity. So really important to keep that also in mind. And the third thing I would say is to have that long-term outlook, to have patience. The markets will not always behave as you want them to. In fact, most times they will not behave as you want them to, and so you really have to be able to wait it out.
So I think you were saying start early. So, actually 30% or 35% of our registered users are under 30. And I think a lot of them students should be on this call, and I think that's a great advice given. Let's talk about diversification a little, right? So traditionally in India, we've been, investment means equity. Parents say, beta ghar le lo. So obviously you get a real estate or you start doing that pretty soon. And then the cars, and then your life cycle of getting married and things like that. But gold, real estate, and equity seems to be the really kind of choice investment portfolio. Why do you think is that the case? And when you talk about diversity, what do you think should be there in a portfolio?
So gold and real estate, because of stories from our parents. हमने घर खरीदा था इस price पे, now it's 10 गुना 20 गुना जो भी है, without really taking into account the time period that took.
And inflation adjusted.
And inflation, yeah.
Okay.
Gold, similar reason people bought it, especially women buy it a lot, and it acts as a wealth compounder. Equity is a more recent thing. I think in many families, parents didn't do it, but kids, because of the social media and the internet, they've learned about it. And in fact, just today we've done a story in Mint called Hazaro Khwahish Aisi. So, of ordinary investors whose small dreams have come true because they participated in the market and they've got those returns. Like somebody, a student was able to buy a motorcycle. A lady was able to take a break from work and have a baby. So, a lot of things happen once you get it right with investing. I think with bonds and fixed income, those stories are not so much there in Indian families because there was no market. If you think 20 years ago in India.
Even 3 years ago, I
Yeah,
think
yeah,
people didn't know what to do. Yes.
yeah.
So that's why, but the fixed deposits has been kind of the proxy, and a very interesting article we wrote on this, that when the banking system in modern world started about 100 years ago, right? So for the Fed and the Bundesbank and the RBI, people before that used to keep money under mattresses or dug in a ground, and then said, this is a safe place, so let's go and keep our money there. But due to financialization or technology advancement, so we still have those old ideas कि अगर fix करना है तो fixed deposit में रख लो, right? But now we have so many more options what we can do, which is a proxy for fixed income. So you think fixed income is an important part or should be an important part of a portfolio? Globally, we talk about a 60-40 allocation, right? Equity versus stable, regular earning income. What do you think the Indian context is for a diversification? If I say how much in equity, how much in bonds, what would you say?
So it depends very much on the risk profile.
Yes.
Somebody who's aggressive can go higher than 16 equity, but
Absolutely.
I think most people are not in that range. A balanced portfolio of some version is good. So I can't give a number, but I would say according to risk profile.
Yeah, but typically we say, at least in an emerging market, a 20-25% of your portfolio could be in regular incoming assets, and that provides stability. We're going to change things a little, so we're going to straight to some questions we've received from the audience. We've grouped these questions together, right? So there's a question from Prakash Panchakar in Ahmedabad, Mayur Mangla in Delhi. What is a bond? How to invest in bonds? And what are some of the biggest mistakes bond investors should avoid? So maybe I take, what is a bond? A bond is you're giving a loan to a company or a government agency. So it is like taking a loan from a friend, like Neil, give me 1,000 rupees. And Neil will say, I will give you 1,000 rupees, but you give me 10% interest on this. Otherwise, I could have to do something else with the money. So similarly, a bond is an agreement, a certificate which says that you've lent money to a company. A coupon is the interest rate, which is in this case 10% that we give. How to invest in corporate bonds? Maybe we'll address this later a little bit. But you can go to your broker, and online bond platforms like IndiaBonds, we will touch on that topic in detail, now gives you access. But what are some of the biggest mistakes bond investors should avoid?
Before that, actually, Vishal, I was just thinking, full marks for having a cool name. Like the asset class, because of the James Bond movies, has that. But Hindi में, is there a word for it? Is there a...
नहीं, हिंदी में नहीं, हमने सर्च किया इसको और वो बॉन्ड आता है, मतलब so it's bond. Fixed income does not have. I did an interview on a Hindi channel, and I had to Google some of the words, right? So nivesh, investment,
Right.
मूल्य राशि, face value. But bond ka, I did not see one. But if you find some, please share it with me. Audience, if you think there is a Hindi word for bond, please write to us. We'll really appreciate it. Yes.
So coming to the mistakes, I think there are two big ones.
Yes.
One is going by name alone. And I think the best example of this is the Yes Bank 81 bonds. I think people bought them just because of the name of Yes Bank, and we all know what happened to it afterwards, the defaults and the kind of senior citizens who suddenly lost a bunch of savings in those. The other thing is looking at just the returns, looking at just the yields and thinking nothing about the risk. Again, it's happened not only, in the most recent episode is probably DHFL and ILFS and the things that began there, but countless examples.
So I'll probably add, the Yes Bank is very interesting one because it's 81. And 5-7 years ago, I was a FPI trader in India working for the bank, and we had about $2 billion invested, right? So I would say, this is additional tier one. The reason it was issued is from a ratings perspective, you get a quasi-equity treatment for that. And the spread between senior and subordinate was so tight in India that obviously, people claim about mis-selling, bataya nahi hame, kya tha. And I think we have come a long way in terms of the educational awareness. So the one interesting thing, it's actually a sorry situation, but Yes Bank 81 wasn't the only one, right? So when Credit Suisse, the big Swiss bank, which was forced to be taken over by UBS, another big large bank, $16 billion of 81 was written to zero. So it proves that, you should read what it is. Khali naam pe mat jaiye. One more aspect you said was very interesting. I see a lot of bonds saying these are secured. Now, what does secured mean, right? Because secured could be you're secured against a property or you're secured against, in India, typically secured means balance sheet assets in general. Some of the bonds I've seen, they say secured against loans 1.1x cover. So मैं आपसे भी पूछूंगा, but 1.1x, but these loans could be highly risky loans, right? So is that the right number? It's not the. What does a normal investor do? How do we select, or what do we see?
I was just thinking of another famous example of secured bonds that had an episode of late, which is Shapurji Palonji. So they were secured against Tata Sons shares, which everyone thought was blue chip, right? The holding company of the biggest conglomerate, one of the biggest conglomerates in India. And there was news that came about where they had delayed payments
Yes.
of one of the coupons. Now that seems to be resolved for now, but it brings home that point that secured means exactly what is that security.
No, so we don't comment on individual names, and in this case, in my earlier job, I was associated with some of this name. But very interesting point, and maybe this is part of the bond risk, and this is also to our audience. These bonds were triple B minus local rating, and as per public sources, they priced at 18.75%. So typically, I think the buyers should be aware, credit ratings are very, very important aspect. And triple B to triple B minus are really, really high risk bonds. And, people who are specialized in that, credit funds, bank funds, people who have armies of doing credit underwriting risk should subscribe. I'm actually surprised that I see some triple B minus bonds marketed as secured investment grade at 12%. So one thing to the audience is, maybe you can talk about credit risk rating and why they are important. AAA, AA, single A, because AAA is like a quasi government bond, trades at 7.25, 7.5. One interesting thing, someone said it's like your CIBIL score, right? अगर आपका score high है, you'll get money at a lower interest rate. If your CIBIL score is low, you get money expensive, and that's what are the ratings. But what is your view on credit ratings, and how important is that?
Super important. I think they should be a primary filter, not the only filter, because again, there are instances like DHFL that were rated AAA and went to nothing. But it is a great starting point. Now, you can build on that with some of your own independent research.
Okay, yeah, no, I agree with you, and especially on these online bond platforms now, by regulation, we are supposed to show the rating, rationale, information memorandum. I always tell to our team, I said, it's your money, the clients, and you should do a little bit more research rather than only on hearsay, which maybe works in other asset classes. Let's move on to something a little different, and probably, as you said, diversification bonds are important. What have been the traditional fixed income investment asset classes? I think you've written a lot on various segments. So maybe just tell us what have been traditionally, take the bonds out, have been for someone to earn regular income, and what are the pros and cons of that?
Yeah, so I would say three big ones. Bank FDs, of course. LIC policies, very interesting because they start paying out after a long period, but people, a lot of people saved into them. And public provident fund, definitely the third big one. And in many ways, each of those has become somewhat out of date, in the sense somewhat not adapted to today's scenario. So FDs, I think the main issue is that, if you think of the post-tax returns, they're often not able to keep up with inflation. What's happened in India over the past 10, 20 years is a lot of people have actually migrated to high incomes, like they're all in the 30% bracket. So it really matters if something is post-tax efficient or not. PPF is still very tax efficient, but there's a cap. You can't put more than 1.5 lakhs a year. LIC policy is less said the better, but the returns are terrible, is all I would say for now.
But one interesting thing, all these three things that you mentioned, all of them are non-transferable, are extremely illiquid, and some have like long periods of lock-in, right? So again, if I convert that and see bonds instead, you can have the flexibility to choose the maturity. There is a secondary market for AAA, AA plus bonds that you can trade in and out of, and you can kind of curate and diversify your portfolio. So I think the time is right for people to, there are $800 billion of household and individual fixed deposits in this country still, right? I mean, we obviously talk about only 9 crore UCCs or traders, equity, unique equity traders, but that 800 billion could mobilize and earn a higher kind of earning from that. But maybe this is a good point. How do you think technology has played a role, since 2019, unfortunate COVID events to now? And how do you see it playing a role in building a financial awareness and then, ease of access? What is your view? I mean, you've seen this market closely for personal finance.
Yeah. So essentially, this has played out very well with stocks. Um, one question was, how do you learn about stocks? And you had brokers like Zerodha basically creating their own playbook, like putting out all of the content. Today we did the same story on Hazaro Khwahish Aisi. All the people that we featured there read about stocks on Zerodha's this thing platform. Um, and in terms of transactions, again, with UPI, with the fact that you can do KYC in 5 minutes and you can open a brokerage account in 5 minutes has changed the game. And I hope that this will also play out in the bond market.
No, so very well said. Well, it is, people do not realize, and strangely, I have some fixed income mutual fund CIOs who are my friends, and I say, do you know you can do KYC in 3 minutes on our platform digitally without any uploads? And they're like, what? Are you talking about the same market? And they've been part of the market for 20 years. You can actually buy a bond in 1.5 minutes. So it's not some new stuff. It's already there in the country. The tech stack is so vibrant that all we had to do is actually adapt and build that digital infrastructure. Work with clearing exchanges, work with the stock exchanges, and say कि sir ये bond के लिए भी करिए, बहुत important है. So now I think a lot of that is, obviously varsity that you spoke about is truly inspirational. In a little way on IndiaBonds, we have a learn section, and we are actually changing it to like a edtech bond university. So we are going to relaunch our learn section where people can search topics. There are about 500 glossary topics. There are videos that we have done. We host a whole lot of corporate webinars, education webinars like this. I mean, you agreeing to come on this was we said, chalo, ye bhi karte hain, try karte hain, and do that. So I think education awareness is completely. What are the risks do you think to technology and access? Addiction or?
Yeah, I mean, that's definitely playing out in the stock.
Over trading, right?
Yeah,
you write
yeah,
a lot about
yeah,
that over trading.
Yeah.
Yes.
F&O, I mean, SEBI's own study shows it. 90% people don't make money. But I think one other thing that is going to be a bit of a challenge on the fixed income side is that it is more difficult to understand.
Yes.
Because you have complex, terminology, like you have coupons and dirty price and clean price, and this takes me back to my CFA. And you don't have this, like with stocks, it's intuitive. You get a share of a company.
Yes.
With bonds, you have to understand 5 different things. So
yes, we try and demystify it. We say face value, coupon, yield, and returns. See, again, the idea that some money should be in regular earning is pretty clear to people, right? So if you have, let's say, 10 rupees to spend, you want to make it 20 rupees. But if you have 10 lakhs to invest, you are a little reticent ki, bhai, can I earn some regular income somewhere? So I do agree, but somehow we feel that bonds are where equity market was 12 years ago. But thanks to technology, thanks to dissemination of information, maybe it'll not take that long to get there. I'll go back to some questions, just to break this. Very interesting. So this is from Subhash Marathe in Pune, Lopa
My city.
Mavani. Huh?
my city.
Oh, your city, yes, of course. Lopa Mavani in Mumbai and Sanjay Bhagat in Mumbai. He's saying, should a senior citizen always invest in AAA or AA rated bonds? What do you think about that?
Difficult question, because AAA, yes, AA. I mean, if the senior citizen knows the risk involved, I don't see even a problem with AA. But you really have to be cognizant of that, because, like I gave the examples, right? DHFL defaulted, Yes Bank defaulted. You have to be smart with picking the right bond.
Yeah, so I think our view is that the risk taking ability for a senior citizen goes down, and it's more about capital preservation. So bond is really a capital preservation instrument, and then AAA, AA plus is again, we do not advise, but is a suggested and recommended one. Very interesting question on this was from Lopa Mavani. Why people do not advise senior citizen to invest in bond? They don't make enough commissions doing that, or
That's always the answer in finance.
yes. So if you sell somebody a government bond, it'll be like 10 paisa, 25 paisa, like
Yeah.
0.1%.
Yeah.
So you think the motivation of the financial machinery, which is the advisor community, maybe is not advising
Yeah, they
accordingly.
gravitate towards whatever pays most commission.
I guess that's finance. But I think this question we already answered. What should be the percentage of FDs, bonds versus in your investment portfolio? I think in an emerging market country like India, it should be 20-25%. Globally, it's 40. But senior citizen, again, up to your risk appetite. But 20 to 30% should be a regular stable income. Is what we feel. Let's come to now maybe talking more about alternative investment,
Yes.
right? So that's something which again you've written a lot on. When you think of alternative investment, because let's say in a portfolio construction, I have example 50% equities, just because we are very bullish in India and we love equities, maybe 60%, and we say 20% in fixed income. That alternative investment can give you very high returns, right?
Yes.
Or how does it play? What are your favorite 2-3 alternative investments, or what do you write about? What do you think is good for people?
So before that, actually, Vishal, let's address the main competitor now to bonds, which is debt mutual funds.
Yes, let's talk
Uh,
about debt mutual funds.
And honestly, that is my way of exposure to fixed income. I invest
Okay.
through debt mutual funds,
Okay.
mainly because I don't have the time and the bandwidth to evaluate bonds directly. And also structurally, until recently, I mean, you weren't able to easily buy them,
Buy
etc.
something.
Yeah,
Yes.
yeah. Um, and tax-wise, also, it used to be a no-brainer after 3 years
The
indexation
indexation benefit
and
advantage.
20%.
Yes.
Now that was taken away by budget 2023.
Yes.
But so that takes away the tax advantage, but the diversification benefit that 10,000 rupees in a debt mutual fund will give me access to 20-30 bonds. Um, I feel is still there. Like, what would you say to that point?
No, so very important question. A very important point that you raised, that investing in debt mutual fund gives you diversity, one, and B, which you may not have touched, is liquidity, right? My point to that is that actually, if you construct your own bond portfolio, let's say you buy 5 bonds. Let's say you want to invest 1 lakh rupees, you buy 5 bonds of 20,000. You will get a lot of diversity benefit, right? And what you give up in so-called liquidity, you can earn about 150 to 200 basis points. But very interestingly, and this is maybe to the audience, in equities you have that. Direct equity and equity mutual funds coexist. And what we learn, and very soon we're going to launch a product where you can click and buy a portfolio of bonds. So that thought has come in our mind, and to our audience and our clients, do watch out. Very soon we're going to come something where you click and you can buy 5 bonds, either based on a strategy or a maturity or an yield, because we do understand that diversity is important. And I think we'll be one of the platforms who can do this, Neil, because at any point we have 60 to 100 bonds on display. Because for a person, what I find difficult, because a lot of, as you said, at a lot of places you can buy a bond, you can buy 2 bonds, you can buy 3 bonds, or you can buy a 15%, a single offering. But when we look at it right from government risk-free bonds to a high-yielding bond. So I think we are in a position to bunch them together depending on the risk appetite and show something. But that's a good point. So debt mutual fund is one. What other alternative investment classes do you think people
Yeah,
should look
yeah.
at?
So the big one that's mushrooming out there these days is P2P lending.
Yes.
Uh, so we did a story recently. Please go to Mint to read it about which is a fintech in P2P lending, and the model that they have built, which is giving personal loans, zero EMI loans, and the lending rate is around 18-20%. They give investors 9 to 10%, and that spread, they say, absorbs the defaults, which they say are currently less than a percent. So that has, because people like the idea of getting a fixed return. I know I'm going to get 9 or 10%. So just curious to hear your thoughts on that.
So firstly, Neil is in his personal capacity, so any names mentioned is is in personal capacity, not necessarily India Bonds or me will share any of those names or reference to that. I think P2P market is a very interesting market. I think in India we are at a very, very nascent stage. And we are in obviously a bull market, whether it's equities or risk. If I see the P2P as an instrument in China, which went through a massive economic disruption in the last 2, 3 years, both credit and global, a lot of these P2Ps, the correlation risk within the portfolio is so high that a lot of these faced very challenging times when any kind of consumer shakeout comes. Uh, my personal view on P2P is that it is a good investment option for institutions or a good investment options for people who are professional in credit underwriting. Now, you yourself said, and I don't know these numbers, that you are giving a loan in 20% and you are selling it onwards. So you're actually buying somebody else's risk at a much lower price. And is a retail really smart enough to know ki if there are 100 or 1,000 loans, how well diversified they are? Or is it a bunch of like, so 1,000 loans might sound diversified, but if there are 1,000 is part of a 1 lakh loans, then which segment of risk, or equivalent CIBIL score am I taking? So I'm not sure that it is an appropriate instrument for retail, but listen, it's a flourishing market, and even in bonds we say buyer beware or any asset class. But I think it's a little bit risky to sell to retail. Again, my personal opinion.
Yeah. So even in my story, that's the one point I highlighted, that as per RBI regulations, currently the maximum amount you can put into P2P lending is 50 lakhs, which keeps out the institutions, which keeps out the mutual funds and the banks, the NBFCs. Whereas in the West, there are no such restrictions, to my knowledge.
Yeah.
So I would rather participate in something like P2P through an institution which is able to assess
The risk pool properly.
Yeah, correct.
Okay. Any other alternative asset? I am enjoying this alternative conversation.
There are a few others, but they're quite niche. Securitization of various things,
Yes.
office equipment, furniture, etc. But the big ones I would say is P2P.
Crypto, any thoughts?
Well, I mean, that wave has come and gone in India at least.
Okay.
Some people obviously made quite a bit of money, but ever since the government put a bunch of taxes on it, it has died down.
Okay, cool. So let's move on to the next bit of questions in this case. This question is from Arun Kamath in Bangalore, and another question from Sanjay Beswal in Gurgaon. Is it a good time to invest in long duration, greater than 5 years bonds? Could you suggest some, if any? So maybe I'll answer the first part. You can take any names that you want. I think it's a perfect time to invest in higher duration, because as we are aware, that inflation we are close to at peak or moderating inflation globally, as well as in India. Obviously, conversely, when equity markets are rallying so much and at all-time highs, it creates more wealth. So actually, it causes more inflationary pressure, and that's why you are seeing central banks around the world, including India, being on hold. But yes, since interest rates move in a cycle, like moving up or down, I think the up cycle has happened. It takes 2 to 3 years. So if you were to invest in duration bonds and you are invested for 2 to 3 years, there is a tremendous chance that your downside is protected and you could also make capital gains. My favorite for more than 5 years, and usually more than 5 years is AAA or AA plus kind of securities. You could invest in government, quasi-government. But let's say government security strips, 0% coupon strips are very interesting play, in my opinion, for duration, because a 20, 30 year maturity, you can, they do not give you any interest rate, but they appreciate because the longer the tenor you have a bond for, more chance of capital appreciation, which we call as duration. But what comes to your mind? Do you think this is a good time to invest in long-term bonds or duration bonds?
So I leave that decision to my fund manager. I invest through a debt mutual fund. But interestingly, if you study what's happening in the mutual fund industry right
Yes.
now, in fact, I was in a debt fund panel this morning. Um, the gilt funds, the average duration of gilt funds has moved really high.
Yes.
So the industry seems to be betting on rate cuts. Maybe they're right, maybe they're not, but something to take note of. What happens when we come into the bond indices, the global bond indices?
Very interesting question. I mean, there's certainly a lot written by the bond market, and Sometimes if somebody else validates us, it's good. Uh, Bond indices is there's only 33 bonds I think in the FAR index, in the Bloomberg index, and the size there are 10% weightage in this index. What does that mean? That foreigners now can openly or will be forced to invest in India, because if I am an investor globally and India emerging market has a 10% weightage, then I'll be forced to invest in India to keep my index correctly hedged, like index funds that you have. So we expect about 25-30 billion dollars for JP Morgan and Bloomberg bond index inclusion to come in. The government bond market is $2 trillion. So how significantly can you impact a domestic market is really the question, because you're a small, relatively a small player. It's big on a global, kind of global landscape. And we do expect that people will start with government bonds, then they'll probably come down the next few years to public sector bonds, and then they'll come down to credit bonds.
You mean FIIs?
Yeah, the FPI,
Yeah.
the FIIs. That I think opening up is a phenomenal thing that has happened for the country. Do also remember that the way foreign investors look at it, Russia is not investable. So if I am in emerging markets are countries that are developing, right? So they're not developed. People do not invest in Russia due to sanctions, and China, because of disruption, has become a little uninvestable. So money has to come to India, given we are top 5 GDP in the world, and obviously top 4 market cap in the world. So let's move on to the next questions. These are from Mohan Kumar Ramakrishna in Chennai, Kostab Agashe. Why, when bonds can be bought in RBI retail directly, why do people go to platforms? My answer to that is, on RBI retail, you only get government bonds, and they are still in SGL format. I think what platforms like us do is convert to DMAT, because investors are used to seeing their holdings in a DMAT account, and they give you a lot more choice. And to your point, the user interface is much more easy and convenient. But maybe this is the time we kind of segue into online bond platforms, right? So the discussion today is how bond investment can become easy for a retail person. So maybe I'll start off. So, this thing started 3 years ago when a lot of people started showing bonds on their platforms, and the regulator, SEBI in this case, said, hey, I have to regulate if you want to sell finance in this country, and came with a regulation of online bond platforms in November 22. So one thing, maybe, when you're investing on a platform, make sure it's SEBI regulated. Because अगर आप कुछ भी खरीद रहे कोई भी platform से bond और वो SEBI regulated है, your layers of protection have gone away, right? Secondly, online bond platforms can only show listed securities. So again, when a security or bond is listed, which means there's again an overview from regulator and SEBI if something goes wrong, and much more disclosure. What do you think these online bond platforms like us are doing, and do you think that we are actually changing this landscape?
So there is definitely a gap in the market, as we discussed earlier.
Yes.
With stocks, that revolution has happened. People do their KYC within minutes. They open accounts and they start trading. And because it's been a bull market, people haven't realized that you need the same thing for bonds as well. It gives you more options in life.
Yes, no, thank you for that. I think what online bond platforms have done is taken technology and made it easier to disseminate information, to make, as I said, in 5 minutes, you can now invest in a bond, which was unheard of. Again, the risks are, which platform are you dealing with? Are you buying listed securities or not? I think that is very important. I'm going to mix this up. Should we go to rapid fire now?
Sure.
And see, so the audience stays awake.
Yes.
You want me to go first?
Sure.
So rapid fire is 10 questions. Nina and I were chatting about this. We're going to ask each other.
Oh no, I just had 5.
So I win. I'll ask him 10, and then maybe he'll ask me 5. Let me go. Financial influencers, yes or no?
Mostly no.
Mostly no. Oh wow. Aren't you one of them also now, or no? Okay. Bonds or debt mutual funds? I think I know your answer.
Debt mutual funds.
Debt mutual funds. Real estate, buying or renting?
Oh, difficult one. Buying to live,
Buying to live, not to invest.
not to invest.
Okay, that's great. If you were SEBI chairperson for one day, what is one thing you would change straight away?
Oh gosh.
Or two things?
Make life easier for registered investment advisors in this country.
Okay. Bonds or FDs?
Um, Probably bonds because there's more flexibility.
Gold ETF or sovereign gold bonds?
Sovereign gold bonds, no brainer, but I'm lazy, so I do ETFs. Confession.
What's your nifty target for the end of the year?
No idea, no clue. And I've been consistently wrong about stock markets. So don't take any insights on that from me.
One expectation from upcoming budget in July.
I hope they will harmonize some of the differential rates of capital gains tax for different assets.
Okay. The best book on personal finance that you have read,
Uh,
except The Raging Bull, but
that's not on the personal
no,
finance. It's
I'm just joking. Yes.
no. So Monica Hallan's book "Let's Talk Money" is quite good.
I believe you're an avid trekker. What is your other passion on your bucket list?
I was an avid trekker until I fell down and had a fracture.
Okay.
Other passion, I read, I swim.
Okay. If you were not a financial journalist, you would be
My very first ambition in life was to be an archaeologist. So that.
archaeologist. Wow. Okay, great. Over to you.
How much of your portfolio is in bonds?
80%.
Could you name some of them?
Uh, no, I would like to stay away from. We don't at IndiaBonds name bonds, but if you don't mind, I would stay away from that.
Okay. How much do you make when you sell bonds on the platform? What kind of commissions do you guys make?
I think every industry needs to make some earnings. Commissions are based on the risk of the bond. So if it's a government bond or a public sector bond or a high yield bond, but it's nothing as crazy as any kind of structured investment.
Okay. Your best investing decision in your life?
My best investing, doing a MBA.
Many people say that, but obviously we go to London Business School, that's a different matter.
No. You know what I think? I think the human capital and human investment is amazing, because portfolios can go up and down, business can go up and down. But really, if a constant journey of self-learning, and being in financial markets, I'm so excited to actually learn every day. I mean, we have a team of 100 people. I don't understand tech. I'm learning every day. So, but an education, a rigorous formatted education, is a human capital asset no one can take away from you.
Okay. Worst mistake you've made?
Worst, worst mistake I have made, you mean in finance or professionally?
In investing, yeah.
In investing, buy China property bonds.
How did that do?
There's $125 billion of bonds issued by a China property company, and the government just shut it down. It went to zero. It trades at 1 cent to the dollar.
Ouch.
And I thought I was a great investor. I bought at 60 cents. I lost all of my money, a lot of my money yet.
Of all the places that you stayed in, London, Singapore, Mumbai, which is your favorite and why?
A very interesting question. Can I? Okay. So Singapore, because everything works, it's great. It's like it's an idyllic location, very friendly government. I love Mumbai because the hustle bustle, the India story, it's amazing. Like when I'm talking to our people, 24, 25, 30-year-olds, and the passion, the dreams that they have, and I think that's part of the India story. London I love because I think it's just relaxed. I mean, you can just go, you can be anybody, walk in the street, no one will tell you anything. So my ideal life when I retire, if I can spend 4 months in all 3 places in a year, it's not going to happen. I have to work for long, but yeah, that's my answer.
That's the dream.
That is a dream, but I don't know when will it come, but we should always have a goal and a dream, I think.
Absolutely.
Good. Okay, that was easy. Thank you for making it easy. I want to basically now come to the risks of bond investment, right? So obviously, people are fully aware that bonds, should be there for diversification. We've spoken about how you can go and access bonds on certain portfolios and platforms. But what are the risks people should be aware of, you think, as an asset class?
So some of the things that we discussed about credit risk, the defaults that we've seen in the past. The other thing is interest rates. People know interest rate risk now if they are debt fund investors, but they may not know it so much if they directly buy bonds. So I think those are the big two.
But I want to talk about this a little bit, and expand on that, because a lot of times when I go and talk to people, they said, "Are DHFL, are the same ILFS names that they were AAA and how they defaulted." Now I must tell you that my observation is that we are not alone. economics and finance can get things completely wrong at some point of time. So for people who remember, there was a 2008 global financial crisis, GFC we call it. There were these CDOs or securitized instruments which are rated AAA by global agencies, and they rapidly defaulted because of the shock to the US system. So it does happen, right? So we should not, I think sometimes we beat ourselves a little too much. And I would talk about that education and awareness was not there, right? And this is my favorite one. I said you should just bury the ghost of the past, right? Does anyone talk about Nifty was 8,000, array was zamana tha, kyun tha 8,000 pay, right? I think a lot of credit cleansing in this country has happened, if you were to agree, and maybe I'll take your views on that. So guys, significantly what happened was India came up with a Indian bankruptcy code in 2016. Now, how do you lend somebody money if you don't know how you'll recover in bankruptcy, right? That was a watershed moment for the country for more reasons than one. Because before that, you had large groups of companies maybe serially defaulting every 5 years and then come back and raise money in equity market, and people would forget about that. The bankruptcy code helped us helped companies to be a sharper corporate governance, right? And whatever happened to DHFL and ILFS was also this unbridled credit underwriting in this country, right? So NPAs of public sector banks got cleaned up, looking so good right now. I think there was some mishaps in the mutual fund industry which have corrected. There was a bubble around NBFCs at some point in time who was doing credit lending. So we are actually in an amazingly clean credit cycle in the country thanks to the IBC, because there is some actual fear in people who run companies that if I default, the company will go away from my hand, which wasn't there 10 years ago. So as we don't live in the past regarding technology, regarding equity markets, I think we should just maybe let the ghost lie still regarding DHFL and ILFS. And these were 5 years, 4 years story. And I think we're in a great credit environment and a lot of regulation in place. What is your view on the credit cycle that we are in?
Yeah, I think there has been quite a bit of cleanup. Not just the IBC, but in general, some of the new measures that the last government brought in. But that brings us to the third thing that we haven't yet discussed in the risks part, which is liquidity.
Yes.
Because some of the alternatives, debt mutual fund, you put in the redemption order, next day the money's in your account. With a lot of bonds, is there enough liquidity?
No, good question. So liquidity remains very, very good in the highest rating, right? So government securities, AAA, AA plus bonds, you have freely tradable thousands of crores of securities trade every year. But if you go in a significant, AA or single A, the corporate segment, the liquidity flows and ebbs. It's a demand supply function. Again, we are not alone. Because I've practiced in the international markets, liquidity flows and ebbs everywhere, right? So US treasuries move 15 to 20 basis points in a day someday. And that's supposed to be the most liquid market. And government securities in India move 3 to 5 basis, right? So liquidity definitely is not adequate in the corporate bond market, but we are not alone there. And if I compare the bond market, and we touched upon that earlier, all the other fixed income avenues, traditional fixed income avenues like, post office monthly income scheme, the PPF scheme, the FD scheme, they all have lock-ins and non-transferability. So you have some aspect of liquidity which exists, but the low rating you go, less liquidity you'll have. And that's why I actually encourage these bond platforms coming up, because we are creating that retail liquidity which may be required, right? So if I'm selling some kind of bonds, and probably I can show bids in small prices or small amounts, not in large amounts. So it's a constant learning, right? I mean, so in any asset class and equity or whatever, I think in bonds, liquidity, we all want more. It's not there, but I think it's still better than the alternative choices.
And through the platform, you do indicate that these are the bonds that have more liquidity.
No, so I think what I tell investors is, you see the highest rating will have traditionally more liquidity. Okay. We do facilitate selling of bonds to clients who have bought from our platform. It's on a best effort basis through our RFQ platform. We are not allowed to show two-way prices, and we are a pure platform. I do not want to take credit risk as such. We are way of working. We don't show BBB minus bonds on our platform. But we do try and help our clients because we feel we are in a system where we see a lot of buying and selling.
Makes sense.
Great. I think we are done for time here. If you have any questions and you've written some questions to us, please email to us, or we will pick it up from the system. We are trying to use maximum time of Neil here to talk to you directly, and happy to answer more questions. But thank you for coming to this show, Neil. Really appreciate. Any last closing comments from your side?
No, Vishal, thank you for having me. If you have any questions for me, you can reach out to me on my Twitter handle, which is ActorsDay, or on LinkedIn or any other platform. But I think we are probably at an interesting juncture in history where if this bull market ends and people finally do begin to think of diversification, some of those infra bits you guys have laid out.
Yes.
So it'll be easier for people then to bring that diversification in.
No, thank you. No, of course. I mean, our intention in IndiaBonds has to be build awareness, build and help build digital infrastructure. But yes, as you said, equity markets have to go down 10%. People to say, "Arey, let me do capital preservation, let me go to bonds." If you think like that, our platform is available to you at any point of time. But closing comments from my side, apart from thanking Neil, we tried this format of a live podcast and more informal discussion, and rather than an educational webinar. We really appreciate the questions you've sent. My team told me to tell you that this is probably the launch of my own podcast in a few weeks' time, and hopefully will bring you more value regarding bonds and life.
Look forward to it, Vishal.
Thank you, Neil. Thanks for being here.
Thank you.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and/or default in payment. Read all the offer-related documents carefully.